Okay. Um, um, good evening. Good evening, all. I'm sorry for coming a bit late. My host, sir. Can you hear me, sir?
Welcome, sir.
Okay, sir. Thank you, sir. Okay. Um, sorry. So welcome. I'm having six of us online now. This is about four of us online. So I have to start now. So please, you give me a little time to screen share to share my screen with you, please. Just give me some time to share the screen with you. Okay. Just give me some time to share the screen, please. Okay. So I'm having about eight of us online now. Yeah. Okay. Thank you for being there. I hope you are keeping safe. Okay. Now we have to continue our lecture. Please give me 1 minute. I need to set up something. I'm sorry. 1 minute, please. 1 minute again. I'm sorry. I'm sorry. 1 minute, please. 1 minute, please. Okay. 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 So sorry. I'm so sorry. I just had a little challenge with the setup today. I hope it will be resolved. 1 minute, please. Please, please give me some minutes. I will resolve this quickly now. Okay. I'm so sorry. I'm so sorry, please. Thank you for your patience, please. So, so I've now gotten the mode. Thank you. Now, I'm sorry for the 8 minute loss, please. Now, in the last voice, welcome to the class. Welcome to the class, please. In the last discussion, we actually talked about the petroleum profit tax, and we explained extensively the graph I put on the board. How do you go about determining the tax liability of a petroleum company? Now, how do you go about determining the tax liability of the company? Now, to determine the tax liability, I mean, I gave you this this graph, this chart, and I explained. I mean, quickly, I explained that under this chart, please, the next 5 minutes, I'm moving to the computations because we don't have time. I have two topics to what to deliver today. So please just quickly listen. Now, I explained that all the income into to petroleum company are what are termed as what are the accounting profit. And the accounting profits are actually divided into three. I mean, that's the income that comes into petroleum organizations. The three are the income that comes from oil, the income that comes from what from gas and from other income. They will state it in the exam. Your oil, gas, and other income. Oil can either be downstream or upstream. I explained that the last time, and downstream is more of the refining, transportation of what of crude oil, and it is not all about explorations. So what you'll be given in the exam mostly is that of the exploration, and that is what we term as what are the upstream. So upstream activities are what are that of what activities of the petroleum organizations that deals with what with exploration of crude oil. Now for the upstream, now we have local and what and exports. You can either sell the oil locally or what or you export it. If you are selling locally, you're selling locally, the rate at which you'll be selling it will be at the rate at the local rate. Obviously, that's the rate at which you're selling it in the country. They'll tell you the rate. But if it is export, I guess me now, you won't sell it at any price other than other than the posted price. I explained that there will be a posted price, and that price is the price that will be recognized all over the world. I mean, for that particular type of of oil, and that posted price is what we have here. So, aside that, I explained that I will say we have gas. Gas always have the what situation where what it will escape. I guess what I'm saying now. When you leave the gas from a location to another location, there will be an escape. And that escape simply means that there will be a discount on that gas. And that discount is what we are talking about when we talk about what the G factor. That's gas adjustment cost factor. And when we say the G factor, that's the discount on what's on the gas, based on the level of escape of the what of the gas. Therefore, in the cost of loading the gas, there will be a degree of what of loading. That's the loading factor. And that loading factor is having a corresponding gas adjustment cost factor. So that gas adjustment cost factor is what you have to determine in the exam as a discount on that gas, which you have to do in this question. And we have other income. Now, apart from all that, if you had other income, gas, and the oil, if you add it together, it gives you accounting profit. Now, if you get the accounting profit to less all the allowable expenditure, which I explained to you the last time, is if all the allowable expenditures, these are the allowable expenditure, bad debt, and so on and so forth. All these are the allowable expenditure. If you add it, note, part of this allowable expenditure is what? Is part of the allowable expenditure is what? Is education tax. I guess what I'm saying now is education tax. So we'll look at the way they compute the education tax later. So after you remove the allowable expenditure from the accounting profit, then you have your adjusted profit. Now, if you get adjusted profit, you less your loss before what? There's any loss before from the previous period. You less it, you have what? Accessible profit. Now, your accessible profit now is what you now less your capital allowance. Now, the capital allowance under the petroleum profit tax is actually divided, the way you get it, I divided into two parts now. You get what I'm saying now? The lower of this A and B is what you pick as a what? As a liable expenditure. I mean, as a capital allowance. And your capital allowance now, for you to compute it, the qualifying capital expenditure that you are using to compute to determine to do the business will be attracting annual allowance. There is no initial allowance under petroleum profit tax. Now, that annual allowance will go for 20%. That's 20% will go for, that's 5 years. Now, that's why I put here 20, 19%. Okay. Have any questions? Okay, any questions, please? The voice is breaking. My host, can you hear me, sir?
I can hear you.
Okay. Carlo Benedicta, please. Can you check your um your network, please? The voice is my host can hear me. Now, if you look at it, the annual allowance is this, and also they also have additional allowance, which is petroleum investment allowance. I guess what I'm saying now. That petroleum investment allowance will now depend on the location of the what of that qualifying capital expenditure in the what in the water, either it's onshore or offshore. If it is onshore, they will tell you it will be 5% that will be petroleum investment allowance. If it is offshore, depending on the location, which is between 0 to 100 meter, it is 10%. Between 100 to 200 meter is what 15%, and above 200 meter is what 20%. So after you have computed that, you now add it with the annual allowance. What you get is what is your A. You now compare this A with this B. The B is what 85% of the accessible profit. 85% of that, this is accessible profit. 85% of it is this. You now less 170% of the petroleum investment allowance. You have computed petroleum investment allowance here. Whatever you compute as PIA, petroleum investment allowance, you now less it from here. You now have the value for the B. Between A and B, whatever you get in A and whatever you get in B, the lower of the two is what will serve as your capital allowance. Now that will be what will be removed from your accessible profit to now have your what? That's what will remove your accessible what? Accessible profit to have what we call your what? Your chargeable profit. So it means that if I remove capital allowance from accessible profit, I'll get my what? My chargeable profit. Now, after getting my chargeable profit, then 85% of the chargeable profit is my what? Accessible tax. Now, if I get my accessible tax, then depending on the agreement between the oil company and the what and the NNPC, the agreement can either be joint venture agreement or production sharing agreement. That will determine what will be the what? An offset on the what from this tax. Offset is like a discount given. I get what I'm saying, or a rebate given on the what, or the tax liability. I hope I get what I'm saying now. Now, if it is joint venture agreement, to be stated in the question, based on the joint venture agreement, how much should be the offset? And if it is what? Production sharing contract, the way you what? Production sharing contract, the way you get the what? Tax offset will now be what? The accessible tax you computed, that accessible tax is computed, you now less 50% of the chargeable profit. We are going to chargeable profit before. 50% of it is what we will now less from the accessible tax. What we get now is what will now be shared between the what? NNPC and the oil company based on the agreed sharing ratio. It will be stated in the question. Anyway, so anything you get there, either is the question state joint venture or production sharing contract, whichever the one they say, anything you arrive at in either of the two is what you want to offset from accessible profits and get your chargeable your accessible tax to get your what? To get your chargeable tax. And that chargeable tax is what will now be payable in what to government. Now, the reason why I quickly have to run over this particular flow chart, I know I did that last week anyway, was because we have some of our colleagues that actually chatted me privately. They discovered me privately that they were not in class because of maybe traffic and so on. I guess that's why I have to quickly look at it, because I want you to sit back, look at your material, look at the material I sent, and look at it deeply and see the way they work. I linked them. That's the reason I put this chart on board. I hope I get what I'm saying. So please notice. So let us now look at, in the course of the past questions, I'll be explaining the nitty-gritty of this chart. I hope I get the computation you need to do and so on and so forth. I'll be explaining them. Let's start with this. Look at this happens to be, I think, 2018 questions or so. Look at Olu Oil Limited has been in the oil prospecting business in one of the world's major oil fields in Niger Delta region of Nigeria since 2009. The company has provided the following operational result for the year ended December 31st, 2015. Look at the operational results. that was provided. Look at it. There are type of crude oil and sales statistics. Look at the type of crude oil they give. There are 3 types of crude oil. The first one is Bonny Light. The second one is Bonny Medium. While the third one is Focados. Now, that's the type of 3 types of crude oil that they're selling under the olive oil. Now, for the Bonny Light, they're able to sell 35,000 barrels of crude oil. They exported it anyways at 39 degree API. That's the American Price Institute, Petroleum Institute. You see, this API is what will give us what the pointer to the posted price that you're going to sell the oil outside Nigeria. I get what I'm saying. If you are selling a oil outside the shore of the country, you won't use any other rate. The rate you are going to use will be the one as determined as making reference to the API of that oil. And this API shows us the quality of the oil based on the content of the sulfur content of the oil. Now the sulfur content of the oil tells us the quality of the oil, and that will determine the posted price that we're going to sell the oil outside the shores of the country. But you see the way we determine the posted price now using this API. You see the way, but look at it. Each of these oil will come is expensive API. I guess what I'm saying now. If you look at the Bonny Medium, we sold the 25,200 barrels at API of 35 degrees, while the Focado 16,300 barrels at exported at 32 degrees. Now, they now say the price per barrel. Look at the price per barrel. The Bonny Light, how much is the price of the Bonny Light? It's $52 at 35 degree API. You know, the standard API for this oil is at 35 degree API. But the oil you are now selling, the API of the oil, which happens to be the indices of the price you're going to sell the oil to the outside of the country. If the API is now higher than this standard API of 35, as stated here, it means that you need to adjust this price. This $52, you now adjust it to reflect the API of the oil you are selling. I hope you are getting me. Look at it now. For the Bonny Light, what is the API of the Bonny Light that we are selling? 39 degree. What's the API of the standard API of the Bonny Light? It's 35 degree, which means that the one we are selling is more than this 35 degree by 4 degree, which means that the $52 will be increased. I guess what I'm saying now. So they will tell you what is the change. Every degree API changes. I guess how much dollar will it attract? That will not tell you how much you are going to add to this $52.03. Now, look at it now. For the Focados, the standard API was 35 degree, but the one we are selling is 32 degree, which is lower than 35 degree, which means that you have to deduct or reduce it for 10 degree. I guess what I'm saying now. For $10 to reflect the difference in the API between the standard and the one you are given in the question. I get it now. But if you look at the Bonny Light, the API 35 was at 35 degree. Why that of the Bonny Medium is wrong? It's also the same at 35 degree. There won't be any adjustment. I get me. Which means that the price here will now be the same thing as the posted price we are going to sell the products outside the shores of the country. Look at what they said. They now say actual realized price was arrived at after adjusting for the variance in what? In API. For every API, that's the degree of API, $0.03, that's cents, was the variance in price at 35 degree API. It means that if the oil you are selling is having an API that is more than 35 degree, for every degree increase in that API, we are charged what? $0.03. So what does that mean? It means that if, based on these Bonny Lights now, that you're having a 39 degree here, as compared with 35 degree, what's the difference now? The difference is 44 degree. That means that 4 degree times $0.03. That is what you're going to add to this $52 to give you what the price are going to sell the oil outside the shores of the country. I hope you're getting me now. So that is that for the oil. Look at the second one. Now, you're now told that that's for the export anyway. Now, for the local sales, we are told that the local sales, they sold 32,750 barrels crude oil was produced and sold at the rate of 345 naira per barrel. You don't need to adjust anything on that. That price is what you are going to see. You sold that, and that's the price you are going to effect when it's a locally sold was oil. But the one that is exported, I guess me, the price I'm going to use should be the what? Should be the posted price. I hope you get that now. And that adjustment was also I explained to you now. Now, Olu Oil is also dealing in gas. Look at the two contracts what they have for the gas. Obi Limited and Oba Limited. Now, for the Obi Limited, what's the value of the gas? The value of the gas they sold was 42,285,000. While the value of this for Oba Limited is 7,775,000. But they give you the loading factor. That loading factor you are given will now is what will give you a pointer to the discount you are going to give to those people that you are selling it to. This to the what due to the escape of the gas, because the gas will always escape, and so far it's escaping, you have to give the discount to the person that was to the company you sold it to. That discount will be determined using the load factor. You see, you will see the way we run it. Now they say that there is a miscellaneous income of 125,800,000, 800 and 300, and 25,800,000 and 300. That's other income. Are you listening me now? Let's look at it. The expenses now. Look at their expenses. Intangible daily costs, rent, royalty, interest, transport, non-productive rent, depreciation, operating costs, donations, pension contribution, and so on and so forth. These are the expenditure. What we need to look at under the expenses here is that what are the expenses that are liable? They call them the what? Expenses as contained in what section 10 of that PPTA Act. That allowable expenditure will be the one that will follow the what? The REN, that's wholly, reasonably, necessarily, and exclusively test. All this will have to be taken care of. Now look at it. We now look at the miscellaneous income. You know, part of the income that was the miscellaneous income, it included 105,500,000 from the sale of what refined petroleum products. Enough. They refined this. This will not be an upstream transaction again. It will be an upstream transaction. It will be a downstream transactions. That downstream transactions will be taxed under the Company Income Tax Act. Therefore, this income now will be deducted from the miscellaneous income. I guess I'm saying that because you are going to tax it under the Company Income Tax Act at 30%. Now, they now say an equivalent attributable expenses of this income. Expenses that relate to this income was 88,240,000 was included in management and administrative expenses. I hope you're getting me now. These are the expenses that relate to this. It means that you go to the administrative and management expenses, you're going to remove 88,240,000 because it has to be what? It has to go into company income tax. I hope I get what I'm saying, because he said it's the expense that is related to this 105,500,000. So please note it. Now, aside that, you are told that interest paid okay, look at it. You are told that interest paid included 5.35 million, which was paid towards Prince Limited, an associate company. This is an associate company. We want to look at it that interest paid. If they did not tell us that interest is at the prevailing interest rate in the market, then it will not be allowed. But if they said that interest that they were paid, which include this, which was paid towards Prince Limited and associate company. You know, associate company is a company of a related transactions. I guess related party transactions. I guess what I'm saying now. And when you have a related party transactions, there is a possibility that the transaction will not be done at arm's length transactions, right? Therefore, we always disallow those items unless in the question you are told that interest was actually made at a rate that is equivalent to the rate they give in what's in the market. Yes, you will disallow it. But in this instance here now, they did not tell us. Therefore, it's likely that we have to disallow it. Let's go. Now the donations. Look at the donations. The donations will have to be the donation that is allowable by the tax authority. Look at the donations. Now, For the donations, the donation to Nigerian political party, that's not allowable. Donation to the Boko Haram Victims Rehabilitation Fund, that's allowable. And Society for the Blind, that's allowable. If you go and look at the fifth schedule, I guess of the allowable donations, you realize that there are other Boko Haram victims there. So all these are allowable. So please note that. Also, the pension scheme was approved. So far they approve it, you allow it. Exchange loss on remittance amounting to 3.2 million was included in management and admin expenses. Because they are into the business of exchange, it's neither here nor there. I told you the last time. I guess what I'm saying, but most importantly, we allow it. But mostly, allowability or non-allowability of this kind of exchange loss will be permitted by the tax authority. Either they permit or not will determine whether you're going to allow it or not. But if you allow it, tell the examiner that allow this. I guess because this company is also dealing with what? With exchange of dollars and so on, and that can be exchange dollars and so on. Therefore, now we can allow it. I guess it was the liability will now be at the concession of the tax authority. So please know that. Now we see the way they treat it when I get there. The schedule of qualifying capital expenditure. Look at the capital. That's this way I have to pay attention with to you. Look at this. Look at the asset type: building, pipeline and storage tank, and plant and machinery. What are the dates of acquisition? February 10, 2013, this 2014, 2015. And this particular question is 2015. Which means that all these assets will attract annual allowance because they have not actually stayed more than 5 years. If they have stayed more than 5 years before this year we are talking about, then you will not compute the what? Annual allowance on it. But this is 2013, 14, 15, and we are in 2015. If you look at the question. Therefore, you will compute annual allowance on each of the assets. That's one. But for the petroleum investment allowance, it has to be computed on that asset that was purchased in that particular year in question, which is 2015. If you look at it, the only one that was purchased in 2015 happens to be plant and machinery. Therefore, that is the one that the petroleum investment allowance will be computed on. Don't forget in the exam that the petroleum investment allowance will be computed on the asset or the qualifying capital expenditure that was acquired in the year under review. While the annual allowance computation will be based on the number of years you have acquired the assets and the years in question in which you are computing the tax liability. If between that year you acquire it and this particular year under review is more than 5 years, it means that you will not compute annual allowance of that qualifying capital expenditure. But if it is more, you can go ahead and compute it. I get it. So please note it. But if it is fifth year, exact fifth year, it is 19%. You are going to compute it. You know, in my graph, I said 20, 20, 20, 20, 19. The fifth year annual allowance will be 19%. Please don't forget. Adjustment number 12. They said there was a capital allowance brought forward of 12.7 million. I adjusted the solution because the one they had in the pathfinder, they made a mistake in it. They did not adjust for this capital allowance brought forward. It has to be adjusted. Please notice 12.7 million. That's what it was adjusted alongside. The rate of what exchange was what 160 to US dollars. It is whatever you are selling out of the country. I mean, what you are exporting. The rate of exchange you are going to use will be 160 US dollar. Don't forget. Now, for the gas, we talked about the other time. You know, I told you that they will give you what? They give us a load factor. Look at the load factor. Now, an example of a load factor and their corresponding G factor. But if you look at the gas that we are talking about, they did not give us the G factor. This is what you are looking for. This is discount rate. This is gas adjustment cost factor that will give you the discount that will be given on that asset, on that gas, based on the level of escape of the gas. And that gas and the G factor will not be given directly. What will be given is the load factor. You will now use this load factor to convert to the G factor. I get similar. If you look at the question, look at it. If you look at the question under the gas, they give us the load factor of that gas to be 62 degrees and 74 degrees. You will now go and look for equivalent G factor. That's gas adjustment cost factor of that of this expected load factor. Again, is that gas adjustment cost factor you can get? That's what you now use to determine the discount on this one, on this oil. I hope I get on this gas. I hope you get what I'm saying now. You see the way I will do it in the question. Now, aside that now, you're now required. Look at the requirement. They said, requirement, explain, evaluate the transaction and advise management on assessable profit, chargeable tax, and what? Total tax liability payable. Look at it. I told you, they said if they say advice in the exam, you have to make a statement. Don't just compute and go. I've told you, don't compute and go. You need the examiner say advice. You need to write a note, a letter, put the headings, use a letterhead paper. No, design a letterhead paper of the one that suits you to prepare the advice. You're going to lose mark if you don't do the advice. So it's very important. So now look at it. Look at your advice. Solution. The managing director, Olu Oil Limited, 250 oil, this and so on, Port Harcourt and so on. Yes, sir. With tax matters, we hereby state as follows. We have evaluated the operational result of the company and so on. Before we go to the advice, let us first go to the computation. Let us first look at how this will be computed. How they arrive at all the answer. Let's start. Now, I want your attention. Look at the computations. Now, we start with the accounting profit or the total income. The first one is export sales. What did we sell? How much did we sell of the oil? We say that's working one. Let's go and look at the working one and see the way they derive the what, the sales, the export sales. Look at it. Export sales working one. You know we have 3 types of oil based on the question. We have the burning light, we have the burning medium, and we have the focados. Now, the standard APF for all the 3 oils is 35 degrees. You agree with me? I told you that. This standard APF, 35 degrees, and the rate at that 35 degrees, the price at each of the 35 degrees is for $52, $49 for burning light, and $40 for focados. Now, for the oil we now want to sell now, that type of oil that we're selling now, what are the API? For burning light, for 39 degrees API, 35 degrees for burning medium, and 32 degrees for focados. Can you now see? There's a difference of what? Of 4 degrees in burning. That 4 degrees, is it increasing or decreasing? My host, please, can you hear me, sir, please?
Please go ahead, sir.
Okay, thank you. Now, if you look at it, there's a 4-degree increase in this API for burning life. For burning medium, there is 0-degree increase. Because 35 degrees was standard and the actual was 35 degrees, actually 35 degrees. There won't be any increase. But for the focados, there's a decline in the APF from 35 degrees to what? To 32 degrees. Can you now see? So that means that there will be 3-degree decline for focados, while for the burning light there will be 4-degree increase. And for every degree increase, you have been told that what? The rate of what? The amount that will change, the value of that increase in cent, dollar, is 0.03. Therefore, for that 4-degree increase, it should be 4 times 0.03, which should be 0.12. That's 0.12 cents. That is what you are adding to the price of the world of the burning light. Can you now see? It's 2.03 plus 0.12 is giving you 52.15. That is your worth. That is your posted
posted price. Now for the burning light, so far there is no change in the degree. Therefore, there will be zero what? Increase or decrease in the price. Therefore, it will still remain 49.04. But for Gallos, there will be a decline because there will be a decline of 3 degrees in the API. And the rate of degree changes in what in the degree of the API is 0.03. You now multiply by 3, it gives you 0.09. That's what you are removing from the what? From the price of the what? Of the Focado to give you what the posted price. Look at it. The posted price you are now going to use for new light is doing the 52 degree now, $52, $52.03, it will be $52.15. This one will be $49.04, and this one will be $48.2. Now, if that's the case, what's the exchange rate? They say that it's 360 naira per dollars. That is why I now multiply that dollar rate by the rate of the what of the exchange into naira. It's 2.15 to 330 give it 18,774. How many was the burning light that we sold? We sold 35,000 barrels. We now multiply 18,774 times 35,000 barrels. What do you have as the revenue? We have 57,090,000 naira. That's total sales, export sales. For burning medium, $49.04 times the rate of exchange of 360, which gives you 17,654 naira times 1. How many barrels? 25,200 barrels. You do the same thing for this. This will give you the total revenue of this. Add the 3 together, it gives you what? 1,384,818,489. That's total export sales. I don't know, maybe we have any question. We have 70 people on board. If you have any question, you let me know, please. These are for the export sales. Total export sales, we have 1,384,818,480. If that's the case, you can see this is the export sales now. 1,384,818,480. That's that. After getting the export sales, after adjusting for your API and so on and so forth, you now go to the local sales. You know the local sales, they said they sold 32,750 barrels. What's the rate of what per barrel? Is what 345 naira. You know you don't need to exchange this. You don't need to exchange it to what to what's the dollar rate or exchange rate or 360. No, because you're selling this locally. And how much are you selling locally? You're selling at what 345 naira locally. That would be 345 naira times 2,750 barrels. You give me 11,298,750. That's the local sales. If you look at it, you added 11,298,750. Now, if that's the sales, if that's the case, you now go to the natural sales, which is in working 3. I guess what I'm saying now. You know, working 3 is now the natural what? Natural sales. Now, if you're not looking at natural sales, how do you go? You know, the working now is now a bit different because you'll be looking at load factor and G factor now. Let's look at the workings. Look at it. Now you need to be a bit patient here. You know, we have 2 contracts, OB and OBA. Let's start with the OB Limited. We sold to OB Limited, but what we sold to the OB Limited, what was the contract like? Look at it. Coming. You can see the load factor of OB Limited happens to be 62 degrees. While OBA Limited is 74 degrees. You now pick, let's start with the OB. OB happens to be 62 degrees. Now, and in the question, we are told, we are given a series of load factors and their corresponding G factor. You just use a way of manipulating this series of load factors so that you can get the corresponding G factor of what of the OB Limited, which was 62 degrees. You know, the load factor of OB Limited happens to be 62 degrees. Any questions, please? Okay, I'm listening. Okay, Ogolo. Okay, let me look at it. There's a mistake in the first revenue composition. So it should be 657 and not 57. Okay, let me check. 657 and not 57. Maybe the person that computed it. Sorry, tell me. Tell me. I'm trying to get. Is it in the working that you're talking about? Or I'm trying to get your view. Okay, I want to get where you get that from. For Bonnie Light. Okay, for Bonnie Light. Okay, let me see. Okay. 657. Okay. Okay. 657090 for Bonnie Light. Okay. I'll get it now. Okay. Okay, I've seen it. 657090. Yeah, that's correct. But even if you add it together, it will still give you. So please note it. I think they made a mistake in this multiplication. 18,774 times 35,000. It gives you 657. That was a mistake. But in totality, if you add everything together, it should give you 1 billion. I hope you get what I'm saying now. 1 billion. That would be yeah. The 7090. Okay, I've seen it. 657. I've seen it. Thank you, Omumbolale Phillips. Thank you so much. Now, at the end of the day, we still get the 1 billion. So please, you can write it up when you print out 657. Thank you. Thank you for the observation. Thank you. So, but if you still add the 657 alongside with 444 and 282, to give you 1.1 billion something. I get me the exact value. Thank you for the work for calling the attention. Now, thank you. Let's look at the local sales. We've got the local sales. We're not looking at natural gas. Now, where I was before we moved in. Thank you for that. We said for the natural gas of OB Limited, the load factor happens to be 62 degree. And we need to look for the corresponding what? G factor. You know, in the questions, you are given several load factors and their corresponding what? And their corresponding G factor. Look at it. Look at the load factor. 60, 50, 60, 70, and 80. Look at their G factor. 16.9, 15.5, 14.3, and 15.6, 13.6. And I'm having 62. Now, if I have 62 degrees and I want to get the G factor of 62 degrees, what can I do? I can say 60 minus 62 over 60 minus 70. 60 minus 62 over 60 minus what? Minus 70. I hope I get what I'm saying now. If I do that, I can now say, what is the G factor of what? Of 60. That's 50.5. Minus G factor of 62. I'm looking for it. I can say X degree. Over 60 minus 70, which is 15.5 minus 14.3. I hope I get what I'm saying now. So with that, I can derive that of 62. You can still use even 50 degree also. You just need to look at two figures which will include the one you are looking for. I guess what I'm saying now. Look at, three figures. What it will be, these three figures out of this load factor will be inclusive of the one you are looking for, so that you can get its corresponding what? G factor. Look at the way it will be computed. Look at the way it will be computed. For OB Limited. Now, I told you that. I told you that you look at it 60. Yeah. minus 62 over 60 minus 70. Now, you already know what is the G factor for 60 to be 15.5. If you remember very well, that the G factor for that is what? 15.5. You can see. For 60 it was 15.5. For 70 it was 14.3. So if I say 60 minus 62, I'm looking for 62. I'm now saying over 60 minus 70. You understand what I'm saying now? Before you know it, you'll be able to get that of what? That of the one we are looking for. Look at it. 60 minus 62 over 60 minus 70 is equal to, for 60, it was a G factor of 15.5. But I don't know for 62. Let me put X there. Over, for 60 is 15.5. What for 70 is 14.3. That will leave us with what? With the one unknown, which is X. Now, to now get X now, 60 minus 62 happen to be minus 2. 60 minus 70 is minus 10. Is equal to 15.4 minus X. That's 15.4 minus over 15.4 minus 14.3 is 1.2. If you find for X, if you cross multiply and find for X, your X will be 15.26%. That will be the discount we are going to give on the gas sold to the what, to OB Limited. Now, the same approach, we are going to look for OB Limited. Look at it for the OB Limited. Let's finish it. The G factor will go of 15.26%. That's the discount. And the value of the gas contract was 42,285,000. So what's not the discount that will be given? 15.26% by times that value of the contract will give us 6,452,991. That's discount. I'm not going to remove the discount from this value of the gas. That was the chargeable natural gas and the value of the gas we sold effective amount, which will now be called chargeable natural gas. Will now be what? Determined by what? By deducting that discount as computed by what? Using the G factor from the value of the what of the gas sold. That's what now says. For the 2,285,000. Now what's the discount? 6 million and something. If you remove it, you have 35,832,309. This is what you put in your what? In your solution as the value of the what? Of the chargeable natural gas sold. If that is clear. Let's look for OB Limited. For OB Limited, you can see for OB Limited, I'm trying to get the the load factor for the OB Limited gas. Look at it. The load factor was 74. Therefore, how do you now go about the computation of the what of the G factor for OB Limited to get the discount rate? That will be 70 minus 74. Can you see? Over 70 minus what? Minus 80. Can you now see now? It is only that 74 that we are looking for that will be unknown. It will now be 70 minus 74 over 70 minus 80. For 70, the G factor is 15.5. 15.5. Why the 74? We don't know. For 70, 15.5. 70 should be 15.5. It should not be what? 14.3. Let's confirm it. Let's confirm the 70 so that the some of the typographical error that we can face. But just so sorry for that. Once in a while, just so not all the time, but sometimes, it's 14.3. I guess it's 14.3. Can you see 14.3? And that's what we should use. It means that there will be typographical error there. 14.3. Look at this. 70 minus 74 is 14.3. I get what I'm saying now. Minus what? Minus X over 14.3 minus 13.6. I hope you're getting that now. It is not 15.5, it's 14.3 because that's for the 70. So for 70, it's 14.3. For 74, we are looking for it, that's X. 70 is 14.3. 80 is 13.6. Therefore, 70 minus 74 is minus 4. 70 minus 80 is minus 10. 14.3 minus x, that's 14.3 minus x. Over 14.3 minus 13.6, that's 0.7. If you cross multiply and find x, your x now will now be 14%, 14.2%. That's what your G factor, which is your discount rate. I hope I get what I'm saying. Now, don't forget, the 15.5 is what 14.3. Please don't forget. Now, if you now compute it on the value of the gas, it will give you 3,894,055. That is my discount. That discount now, what do you have? What do you do with the discounts? You now remove the discounts from the value of the what? Of that gas. You can see the value of the gas, initial value of the gas happens to be 7,735,000. You now remove the discounts that you got during the G factor of 3,894,055. What you get is what? 23,880,945. I hope I get me now. So the total chargeable natural gas now will now be addition of what? That of the what? OB limited, which is 35 million. That of the urban limited, which is 23 million. That will give me what? That will give me 59 million. They added this 35 million and 23 million together to give you 59,713,254. That is what you leave in your computation. 59,713,000. Let's look at it. 59,713,000. Can you see in the working trees? Now, we have been able to look at the export sales by doing our posted price. We look at the local sales by using the local rates. We look at the natural sales, natural gas sold by looking at the load factor, and the G factor. And it's true that there is a miscellaneous income. Let's go back to it. We have a miscellaneous income. How much was the miscellaneous income you are given in the question? Miscellaneous income was 125,800,300. But in the notes, they said this miscellaneous income in note 6, please. Miscellaneous income included 105 million from the sale of what refined petroleum. When you are selling a refined petroleum, you tax it under what? Company income tax, not under petroleum profit tax. Therefore, you are going to remove the 105,500,000 from the what? From that value of what? Of total miscellaneous income of what? 125 million. The difference is what you will put in your what? Under your PPT computation. I hope you are getting what I'm saying now. Now, let's look at the way you put it now. Now, in this instance here now, you can see, they now say 125 million, which was what they give in the question, minus one that relates to the refining of the oil. And that's what? 105 million. What's the difference? 20,300,000. If I add all these three together, all these four together, that would be the accounting profit or the total what? Total income from the what? From the oil activities. Don't forget, this is the income for the downstream. I mean for the upstream. I'm sorry. This is the income for the upstream because it is the upstream that involves in explorations. The one for the downstream will now be what? Will now be taxed under the company income tax, and that's the one where we remove from that miscellaneous income. We'll treat that one separately. Now look at it. Less allowable expenditure. That allowable expenditure is able to be in section 10 of the Petroleum Profit Tax Act. Please note, in this exam, you need to be able to do more of past questions, so that you'll be used to some of these allowable. Because in this class, I will probably not be able to tell you all the allowable expenditure that is allowed, that you can meet in the exams, as far as PPT is concerned. But if I had to be you, I guess what I'm saying now. Though I picked all this from your pack, some of this expenditure and all that, and all these are in your pack also. So even if you can, even if you are reading your book, if you see any of those Any of those expenditures that are not captured here, please pick them out because they can ask it. And it's only you have treated it before that you'll be able to know that they are testable. I hope I get it now. Let's look at it. Intangible dwelling expense. Look at the expenditure that is allowable. That is section 10 on PPTF. Intangible dwelling expenditure is allowable. Rent, obviously, is allowable. Royalty, any royalty either on the oil or the gas that the oil company paid is a liable expenditure as far as PPP is concerned. Royalty on export sales, royalty on local sales is liable. Interest paid. If you look at the question very well, you are told that you have an interest paid. Look at the interest paid. Interest paid, which is 15,350,000. That's interest paid. But part of the interest paid, they say in note 7, interest paid included 5,350,000, which was paid to Prince Limited, an associated company. So far, the examiner did not go further. They are to tell you that though it's an associated company, but the interest paid to them is at what? Or at what? At a prevailing market rate. If the examiner did not say that, it means that that interest that is paid to the related party, I guess it will not be allowed as far as the PPP is concerned. So therefore, the interest of 5,350,000 will have to be removed from 15,350,000 so that you can get the one that is allowable. I hope I get what I'm saying now. So let us now look at the one that is allowable now. In ASIF, to get the one that is allowable, look at it. Interest 15,350,000 minus this, the one that is not alive, will give you 10 million. Please notice. The transport costs are liable, non-productive rents are liable, operation costs are liable, donations. Let's go and check the donations. If you look at it, you see there is the donations of 5,550,000. But in the notes here, note 8, the donation to Nigerian political party is not allowed. Boko Haram is allowed. White Society for Blind is allowed. So it is that it's only these 2 million that will be disallowed. Therefore, in the course of what? Of explaining or doing your work, I will remove or net off for the 2 million. That was being the exam anyway. I will let less the 2 million. Can you now see? The one that was meant for political parties is not meant for the business. So if you say you give APC or PDP 10 billion as an oil company now, as a donations, and you want to allow it for tax authority will not allow you. Therefore, the 2 million will be netted from here, you get 3.5 million. What's the pension contribution? You are told in the question that the pension contribution was approved. That approval meaning that what? The tax authority themselves approve it. The authority approve it. Therefore, it will be allowed. But if the question did not state that pension contribution, the amount of contribution for pension, either for your life or whatever, if they say it is not approved, then it will not be allowed to be able to remove it for tax purpose. I hope I get what I'm saying now. So in this instance, they told us what they approve it. That's why it's. You can see where I'm actually trying to pick out those liable expenses. If you do 12 questions, you want to get used to those expenses. Now, custom duty allowed. But if they put in the questions that custom duty meant for what? For non-essential items or items that are not what? That are not even related to the transaction you are doing or your oil business. That custom duty on it will not be what? Allowed. But if they just put custom duty there, they allow it. And expense abort dues, fine, allow it. That's where you park the abort dues, fine. Repair and maintenance of equipment, allow it. Bad everything up, allow it. Management and administrative expenses. You know, the management expenses was actually inclusive of what? Of an expense that are related to the refining of the petroleum operations. Look at it. They said They put it somewhere there in the notes. Let me try to look for it. They said, should be here. They said, and equivalent attributable expenses. The expenses that relate to this was sale of refined products of attributable expenses of 8,240,000 was included in management and administrative expenses. Can you see the management and administrative expenses of management expenses of 150,700,000? So far, this 88 million was meant for the company income tax. Therefore, I need to remove it from this 150,700,000 so that we get the balance which should be allowable as management expenses involved in petroleum profit tax. Therefore, in that instance, you see the way we work, they remove it. 88 million from 150 million, it has 2,360,000. Now, if you now add everything together, what we get is what 712,244,150. Those are the ones that will be what? That will be allowed. Every other one are not allowed. Even the expenses the other time, please don't allow it. That exchange loss expense, exchange loss. I guess I'm saying that they don't allow it here. Please don't allow it. But sometimes tax authority will actually give a concession to that effect. I guess you know. Now, if you remove it from the work, from the income, you now have this value. Don't forget. I told you that the tertiary education tax is also an allowable expenses, but so far as an allowable, you know, it's a 2% of our stable profit. And in this case now, we are not even gotten our stable profits anyway. Therefore, if you have a loss buffer, I look at your pack because I'm actually working with your current pack. In your current pack, there have contradictions there. About 4 questions they put there. There is a way they treated this tertiary education tax that it makes it confusing. But the one I want you to adopt is one of the ones that they use in there, which we see also in their question. Are you getting me now? Now look at it. So get this, you know, we have left all these expenses, but we have not left the tertiary education tax. Now, if there is any loss, buffer, please less it. You now get this. Now, to get a tertiary education tax, it will be 2/102 of what? Of all the income minus other expenses aside the education tax. It means that all the income we have been getting, we got the income, look at the income, 1,476,000,000, less all these expenses we identify. If you less all these expenses, you get 763,886,634. Now, you now see 2/102. Because what we are putting in 102 is because that education tax should have formed part of the expenses. But if it's not part of the expenses, then for you to now remove it after you have less other expenses, it should now be 2/102 of the income minus all these expenses. Whatever you get is now your education tax, which is 14,978,169. Now let me now tell you the contradictions now in their pack now. Now, assuming there is now this loss buffer now, is it that you are going to less all the expenses alongside the loss? The balance is what you now say 2/102, or you will not remove the loss at all. It is only the expenses that you remove from the income. Whatever you get, you now say 2/102 of it. These two ways were the two ways they use in your pack, your current pack. If you check it after this class. The first questions there, they used in the first question, they did not include what? That losses. In the third questions, they included the loss. So what I want you to do is that when you have this in the exam, I guess you know, so we can see research more fine, but when you have this in the exam, there is a loss here. It should not be income, or income minus the expenses, these expenses, minus if there is any loss, whatever you get as balance, 2/102 of that balance is your education tax. I guess I'm saying that. Let us adopt that. But that was what they used. They used that in their exam pack. But in this analysis here, we don't have any loss ball forward. Therefore, so far there is no loss ball, we have dash there. We had 763, 886, You now see, national education tax should now be 2 over 102 of this value. You now have it to be 14,978,169. If you now remove this, that will now give you what will mean as your accessible profit. Accessible profit. Now, after getting your accessible profit now, then we now want to go and get what is now our chargeable profit. Now, to get my chargeable profit from my accessible profit, I will need to less my capital allowance. Now, to that less the capital allowance is now divided into 2 parts. The first part is for you to first compute the capital allowance proper, including the petroleum investment allowance, and add it together. The second part is to compute 85% of the accessible profit. You now less the 170% of the petroleum investment allowance from it. Now, between the two that you computed, the lower of these two is what will serve as a wall, as your capital allowance to be removed from your accessible profit to get your chargeable profit. Let us look at the way it is. Now, let's look at the first part. This is accessible profit. Let's look at the capital. To use the capital allowance, let's put the first one. What the first compute? Sorry. What is 85% of accessible profit? You know, my accessible profit here was 748, 908, 465. Go and compute 85% of this value. It will give you what? The accessible profit of 163,572,195. You now say less 170% of the what of the PIA. Now, we have not computed PIA yet. So if we need to compute PIA, let's go to this one. We'll still come back to this one. In the exam, it's better for you to first compute this capital allowance first. Therefore, after computing this one, then you now go ahead and compute this one before you now compare. Let's first compute the capital allowance. Now, you know there's a capital allowance brought forward of 12.7 million. This is. Now, let's now go and look at capital allowance for the year. I think that the capital allowance for the year will be computed provided a qualifying capital expenditure is still within the 5 years of buying. As I mean, when you compare it to the date of birth, to the year in question you are paying the account. I hope you get what I'm saying now. Now, if you look at it, let's look at what they did here. Look at it. The qualifying capital expenditure are what? They have building and pipeline. No, they have building and pipeline storage tank. They have building, pipeline storage tank, and they have what? Plant and equipment. Now, for the building, that was in the acquiring what? They acquired the building in what? In 2013. The storage tank they acquired was 2014. The equipment they acquired was 2015. Now, if you look at the solution, what year are we even preparing for? 2015. Now, so far you know the year we are preparing for to be 2015. Therefore, this was bought 2 years ago. This was bought last year. This was bought this year. Which means that the 3 of them are actually bought within 5 years ago. Therefore, all the 3 of them will be what? They will allow them for what? For annual allowance. Because they are still within 5 years. Assuming this particular building, this was supposed to be building, was actually acquired maybe in 2010 or 2009. You know, 2009 to 2015. You can understand what I'm saying? 2009 to 2015. That's like 6 years. So far in 6 years, that simply means that There won't be annual allowance computed on the asset. Because it's beyond 5 years. But for this one, it's 2013 is still 2 years into acquisition. 2014 is still 1 year. 2015 is still year. This year, everything will acquire annual allowance. But which one will attract what? Petroleum investment allowance. It is the one they acquire in this year in questions. And that's plant and equipment. That's the only one that they acquired in 2015. If that's the case, what are the costs of this asset? The cost of the asset is this. So far, the 3 of them will be worth. Will attract annual allowance. And annual allowance is always 20%, unless it is the 5th year. Assuming this particular building was bought in year 2010, which means that this year will be 2015. That means that you will apply 19% on it. Else, it will be 20%. If it's still within 4 years, if it's still within the 4 years of buying. Therefore, so far this is still within 4 years, 20%. That will be 20% of this, 20% of the 20%. That's giving total capital allowance to be 40 million. If that's the case, we now compose the petroleum investment allowance on, sometimes they call this investment tax credit. I guess it depending on the year in questions. I guess what I'm saying now, investment tax credit or petroleum investment allowance. The petroleum investment allowance will now be only on this plant and equipment. Because that's the only one, because they only compute that in the year in question. If the asset is acquired or acquired within the year that you are computing for, then what we need to do is you need to compute the capital, the petroleum investment allowance on it. Else, it will not compute. So it is only this one that you compute was petroleum investment allowance on. Look at it. Plant and equipment. And if you want to compute, it will now depend on the location of the asset in the water. And the location of the asset, and the location of the asset now. Let's look at the location of the asset. I think they gave us in the question. I think they gave us in the question. Let's look at what are they giving in the question. It says, look at it. This piece of machinery now. It is within 60 meters. 60 meters. And if you look at it, if you within 60 meters of water depth, if you look at the diagram I gave you, look at the diagram. It's 0 to 100 meters. What's the rate of work? You know it's offshore now. If it's onshore, it is all 5% flat. But if it's offshore, they will tell you in the question, you know, 60 meters is between this or 100 meters. You use 10% as your petroleum investment allowance. I hope you can see it. That's why you now say 10% of that value what will suffice for what? The petroleum investment allowance. Look at it. That's when you now say, look at the 10%. I'm coming. Look at it. What's the cost? 2 million. 10% of 52 million. How much is that? 5,200,000. You can see. That is the only one you can put petroleum investment allowance on. 5.2 million. If you now add the 5.2 million plus the annual allowance, that will give you 45,200,000. That will now be added to the world capital allowance go forward. If you now go into their solutions, you can now see capital allowance buffer was 12.7. The annual allowance in question was 40 million. Petroleum investment allowance of 5.2 million. How much is that? 57,900,000. That was why I dropped another page for you so that I correct this for you. In the old solution in the work pathfinder, they made a mistake. They did not include this capital allowance buffer. But if you check your pack, any capital allowance buffer will be added. I hope I can see me now. Therefore, the capital allowance buffer was 12.7 million plus all this give me 57,900,000. That's one part. of the capital allowance. Because if you look at it, the one part is this A now. I've got the initial annual allowance, I've got the petroleum initial allowance added to give me A. And I want to get the B now. Look at the way we got the B now. Let's say this is the B now. 85% of accessible profit. What's accessible profit? Accessible profit is this. It's 5% of this is 636,572,195. And 170% of the PIA. You know the PIA is what? Was 5.2 million. You've computed it before. You know, 85%, 170% of it is 1.7. You know, times that value. You give you the 170% of that value. That's 8,840,000. If you now add with the 85% of that same profit, you get the what? The value here. That's B. Now, if this is the A and this is the B, according to personal investment, personal profit tax, the lower of these two, the lower, not the higher. But if you put higher there, it means that they won't even pay anything in tax. The lower, it happens to be 57,900,000. That's 7,900,000. That's what you will remove as capital allowance. I hope you understand what I'm saying. That's what you remove as capital allowance. Therefore, if I remove it from here, from the accessible profits, what we have? You have the chargeable profits. You can see the chargeable profit now. Now, this chargeable profit now, you now see, from this chargeable profit now, that's when you now determine what is now the tax that is accessible by the company. Now, you now say, on the company, accessible tax now, how much tax is the oil company paying? You're paying 85% of their chargeable profit in tax. Now, the 85% now of the chargeable profit now is now what they assess in tax. That's what they will pay in tax, unless there's an agreement with that company and what an NNPC. And the agreement can either be joint venture and what or production sharing contract. I get what I'm saying now. Now, if there is a joint venture agreement, that means this accessible tax now, you will need to what? Remove that rebate. They will give a rebate to the agreement. They will give you a discount, a rebate. That amount will now be deducted from this one. This amount of 85% of chargeable profits to give accessible tax. If you remove it, that will now give you what to be chargeable to them. What will be the chargeable tax. But if there is no agreement between that company or company and the NNPC, it simply means that whatever they assess them, whatever the accessible tax will be what they will charge them as tax. That will be the chargeable tax. You can see there is no MOU, joint venture, or production sharing contract between the oil company and that NNPC. That's well, what they assess them to tax is the same thing what they charge them to tax. That's why what we have here is the same thing as what we have here. I hope you're getting me now. But if in the question, the examiner now was post it to you, or they was explaining to you in the question that the company is maintaining a joint venture arrangement or production sharing contract. It means that production sharing contract is telling you that there will be a discount or a rebate that will be given to this oil company based on whether it's joint venture or production sharing contracts. That amount that you compute based on those two agreements, any of the two agreements you're giving the questions, that amount is where you now say tax offset here. If it is 10 million, you now say tax offset 10 million. You now remove the 10 million from 587 million. That will now give you 577 million. That's what will now give you the chargeable tax. I hope I get what I'm saying now. But if there is none, I hope you're getting me. Then your accessible tax should be equal to your chargeable tax. Now, if that is chargeable tax, then what's now the tertiary education tax? You know, we are computing our tertiary education tax here to be of 14,978,169. You just bring it here. 14,978,169. But you know, in this question, there is a company income tax aspect of it, apart from the petroleum profit tax aspect. So they say there is the part part of this oil business, part of this this company is also dealing with what? Refining of what and sale of what of those refined products, and they made income from there, and that income will not be part of the PPT. It has to be taxed under the normal company system, under the company income tax, and that's at 30%. Therefore, you now need to go and get what was the income from that downstream operation, and what is the attributable expenses. If you remove it, you now get the profit. You now tax it at 30%. Whatever you get is what will now give your company income tax, which is working WVI. Let's look at the working. Let's see what. Let's see how the working is. Now look at it. Company income tax. Now, for that company income tax now, what's the income from sale of refined product? 105 million. What's related expenses? 88 million. You know, the one we remove from management expenses the other time. Total profit, 17.26 million. What's company income tax? 30% of this. Can you now see it is not 85%? Because this is a refining. It's not a PPT. I hope you get that now. That would now be 5,178 million. 5,178 million. What is the education tax? That will be 2% of what? Of 17,7260. Yeah, 345. Now, these are what they will pay under company income tax. So, you now say 5,178 and 345, 200. You now say, if you now have that, you now bring it here. Now, look at what you now do. Now, you now say, look at this. Tertiary education tax. Company income tax is 5,178. Tertiary education tax again for that company income tax for 345,200. Addition of everything, both for the PPT, the tax on that PPT, the tax on that the company income tax, additional tax on that company income tax. You add all the four together, you now give it to that tax payable by the company. That is that. Then after getting this now, you now go back. Now go and put it in a word, in an advice form. Can you now see the advice now? You now say, we hereby state as follows. We have evaluated the operational results of the company for the year ended 31st December 2015 and the income derived from the following sources. Crude oil sales, crude oil this, and we also consider the expenses and so on and so forth. So you now put it there. You are also enclosing detailed workings of the working. You now say you enclose your workings now. I guess in export sales, local sales, total distribution, and so we will be most obliged to give further information because your social and so on. I guess now. So you can now see, based on what you have submitted, your answer has actually been highlighted. The chargeable profit, the chargeable tax, and the tax payable. All these have been highlighted in your advice, and that solves the question. I hope you're getting that now. Okay. If you have any question, you can ask me, please. Now, for the illustration 2, I want to do illustration 2. It's the same replica of illustration 1. The same approach, just a past questions. But the one that will be a bit different was the number 3. That was the reason why I adjusted that note. I had to send a new one. That number 3, the terminal, this one is the same replica of that. Just adjust for the exports, crude oil locally sold, incidental income, exploration and drilling costs, non-productive and so on, depreciation. All these are the allowable expenses. So qualifying capital expenditure, pipeline and storage, and so they'll give you the location and so on. So, and the solutions are there. So please, it's important for you to look at. But the one the examiner can also twist. The other part of it, they can twist for you, which was also part of their past question. Is this illustration 3? Now look at this illustration 3 and see the dynamics of this question. This is what they call the work back under the petroleum profit tax. It is not like straightforward. You just say accounting profits, less allowable expenses, adjusted profits, less loss really, and so on, less capital allowance, stable profit, tax. That one is straight. Now, the examiner can now ask to work back They now give you the tax they paid, and they ask to walk back. They will ask to walk from the tax, that 85% tax. You can now ask to walk back. So then ask to do that. How do you do that? So how do you do that? Look at it. It said, they find the following in relation to the Petroleum Public Tax Act, the board, the chargeable natural gas, casing head petroleum spirits, and G factor. All these, the notes are there. Are you getting me now? Now look at it. You now said, now, this is where I'm actually going. You now say, SSB Nigeria Limited engaged a firm of tax consultant, PMK, and associates, to compute its petroleum profits tax payable for the year that is December 2014. The petroleum profit tax was computed at what? They said they have computed it. And it was how much? 680 million. They have computed it already. So after they are following the deduction have been made. Before they can compute this, maybe there is a, that simply that there was a mistake in the way they computed it. But they said after they have made the following deductions. Look at the deduction they made. Reality on domestic sales, custom duties and plant and machinery, after allowance brought forward, after allowance for the current year, agreed loss brought forward. These are liable expenses they remove. Now say they got a profit. They now tax it, and the tax is now 680 million. Can you not see? They now say, that one is, this one is not different from the one we did. The following additional information is also relevant. Look at the following additional information. He said MOU. Now this one is now having MOU now. That's joint venture now. No, under the tax offset now. I told you, it cannot be PSC or MOU. MOU is under joint venture. Now, I told that they will give you that MOU. That MOU credit. The MOU credit, that's based on the agreement between the NNPC and the oil company. That agreement made the oil company, made the NNPC to give them was a rebate of 6 million, and royalty on export sales is 6. Other incomes are transportation of crude, disposal of fixed assets, others. I get me. Tangible drilling expenses capitalized, intangible expenses, non-productive rent, additional asset for offshore operations, which is 30 million. You're not hard. You are required to compute the petroleum profit of what? Of SSB Nigeria Limited for the end of December 2014. Now, you have to compute the petroleum profit. Now, this is another concern. This is a past question. And the examiner can also give you an exam. How do you do that? This is the board. The Federal Inland Revenue Board is what they mean. Chargeable natural gas is what is total natural gas is what they sold. Look at it there. This is in relation of the company engaged in petroleum operations. Means natural gas actually delivered by such a company to the Nigerian National Petroleum Corporation under a gas sales contract and casing head. Any liquid hydrocarbon extracted in Nigeria from natural gas. That's casing, and G factor is gas associated cost factor. So if you look at it, please, look at the way you now compute this. You know, the examiner are giving you the words. What was the petroleum profit tax as computed by them anyway? How much was it? 680,000. But you know, before you can get that petroleum profit tax, it should have been 85% of chargeable profit. Is it not? Because if you look at the way we computed the last question that we did, 85% of the chargeable profit is what is paid in tax. I hope you're getting me down. If you look at it very well, if that's the case, then what is now the chargeable profit itself? If 85% of chargeable profit is 680,000, then if I want to get that chargeable profit itself, what do? I will gross 85% up. I will divide the 680,000 by 1.85. If you do that, you will get the what? The chargeable profit. Look at it. That's the first thing you do in the exam. I'm using my calculator now. How much is the 85% in the question? 680,000. In the exam, if they give this kind of question, you say 680,000 divided by what? 0.85. That will give me 800,000. That's 8 million. Because it's part was part of 1,000 of. That's 8 million. Can you understand that now? If 85% of chargeable profit give me a particular tax, then what is that profit? That profit is that tax they are giving me is 80,000 divided by 1. That is 5%. With that, I've been able to gross it up to 100%. Because this is now the 100%, which is now the chargeable profit. But you know, they said before you determine this personal profit tax, they have made some deductions. Now, what you need to do, just close your eyes to that deduction, add all the deduction back. I get it now, so that you can start afresh. So that you can start deduction afresh. Now, what are the deductions? They said they have removed. They said they removed royalty on domestic sale, custom duty, capital allowance, and agri loss buffer. We add everything back together. So what you have there? If I had everything, like, can you see royalty on domestic sale, custom duty, capital allowance, buffer, capital allowance, add everything back to that chargeable profit. You add this, right? Now, this is where you now start now. This that you now add now is like your income now. I get it, because this is what they said they remove. Before they arrive at that profit and that tax. If I had all what they remove, what I get is the profit, is the income. But in that income, there is another other income. Look at it. It is not captured initially. Look at this. They said other incomes, because they said these are the additional information which were not part of what they did before. Let's say other income now. He said other income and transaction of crude oil, that's for the company income tax. He said disposal of fixed asset, that's capital item. That will be tax on that capital gain tax. Let's say others. This others now is 20 million. This 20 million should now be part of the income now. Look at it. If I were to do the exam, that others now is now 20 million. I now add it back to my income to give me the total income now. Can you now see? I'm now back to my income now. I now start removing expenses, capital allowance, and other things. Examiner can come this way. It's not the normal way you normally see. The one we got solved, that's the normal one you see, 80% question you see. But examiner can come by giving you and asking you to work back. They give you the tax, you work back to get what? The exact profit that should be taxed and the exact tax that should be taxed. How can I say that should be what paid? Now, if I had the other income now, what do I have? I have 1.31 million. That's my income now. That's my total income now. And I'll less the liable expense. That's section 10. In the exam, put section 10 there. It will let them know that you will know what you are saying. Not the liable expenses. You now say royalty on domestic sales. You know, if you look at it, you now start picking all the expenditure that is supposed to be removed. I guess me, you know, this royalty on domestic sales, you know, we have added them back together from, you know, it's an expense. You now pick custom duty on plant and machinery, that should be expensed. I guess me now. All this should not be expensive because these are the items you use to treat to get the tax. You don't expense it too. Now, look at other items now. Royalty on export sales, that should be expense. I guess me. Tangible dividend expense, this one is capitalized, it's not expense. Don't put it under expense. When they said it's capitalized, it's not expense. Intangible expenses, that will be expense. You put it under expenses. I guess what I'm saying now. So, if you identify that, then what do you now need to do? You now see royalty on domestic sales, 100. Custom duties, can see 160. Royalty on export sales is 200. Intangible dividend expenses is 100. Don't put the one that capitalized. Non-productive rent is what? Is 10,000. 10 million. If you now add all this together, you now remove it from this 1,310,000. It gives you almost 740 million. Don't forget your education tax. It's an expense. Education tax will now be 2/102 times what? 1,310,000 minus 570,000, which is 740 anyway. If you remove it, that's income minus other expenses. to give me what? 740. It now be 2 over 102 times 740. That would be my education tax. You now remove it as an expense. You now get adjusted profit now. You now let my loss brought forward. Now, you can now see the way they treated this loss brought forward in this question here. You can now see they did not use it to adjust this education tax now. I guess I'm saying. But in your pack, they identified and they used it. So I will advise that, fine, based on what we are teaching, you should now refer to your pack also, fine, when you are reading. Now, that this item should also be used in determining the tax liability. I mean, to determine the education tax. So in this instance, it should have been 740,000 minus 100,000 times 2%, 2 over 102. But in this analysis, they did not remove it. When in your pack, they did that. I will see, before we finish this class, I will still research more on that treatment. But the one in your pack stated that if there is a loss buffer, that loss will be what? Will have been used alongside to get the education tax by saying the income minus what? All the expenses minus the loss, if there is any loss, times 2 over 102. That is what will have been used to get the education tax. But they did otherwise here. So please note it in the exam, and then when you're looking, you look at those differences. I get what I'm saying now. So let's assume that this is what we're having here, because it's already been presented. I get me now, but I actually identify that what you need to do there. Now, this is a stable profit here now, 625491. Now, let's capital allowance now. Can you now see now? They brought forward of 40,000. The capital allowance for the year, look at it. Look at this, please. You know, this is that the capital allowance brought forward was 40 million. The capital allowance for the year was 90 million. That's 1 million. That's 130 million. So if it's at 130 million, what do? You cannot see. That's 130 million. No, you don't need to compute capital allowance then. What you need to go and compute is petroleum investment allowance. Now, you know there is an additional asset offshore operation. They acquire additional assets based on the questions. I think they tell you somewhere there that they acquire additional assets. I don't know. They stated this in the questions. There's an additional acquired asset in the questions. Look at this. Additional asset for offshore operation was 30 million. Up are getting me now. Now, if you look at the additional acquired 30 million, look at this. You now see. To compute the petroleum investment allowance, you now see additional asset was 30 million. You know, they say they capitalize tangible dwelling expenses. That capitalization space that you're adding it to this asset now to give you 150 million. So far it's 150 million, and the examiner did not, just purchase it. I told you that when you're computing personal investment allowance, it must be in the year in questions, right? You just acquire it. That's why you have to compute what PIA on it. Okay, I get what I'm saying. But you will not need to compute the capital allowance, but they have told you the capital allowance for the period. I guess for the current year, they are giving it to you. So I will assume that the capital allowance have been computed of it. Now, for the petroleum investment allowance at 50%, assuming the debt is between, they're not assuming. In the exam, if the examiner did not give you the range or the location of the item that has to get the rate of the petroleum investment allowance, you should assume. I guess what I'm saying now. Don't assume 5% of onshore. Just assume the offshore. I guess you assume if it's 10% or 15%, you assume. Just tell them. So first, the location was not given in the question. Then I assume this. Look at their own solution. The allowance at 15%, that's between 100 and 200. They assume it. The debt is between 100 and 200, right? Now, 50% of 150,000 is 22,500. If you add that with 90 and 40, it gives you 152,500. That is the first part of the capital allowance. Can you now see? Now, the second part is 85% of assessable profit. 85% of assessable profit. What's assessable profit here? our stable profit here was 625491. 85% of 625491 is what 53167. You now less 170% of the petroleum investment allowance. And petroleum investment allowance was what? Was 150,000. I mean, no, that's the 22,500 PIF. 1.7 of 22,500 is 38,250. If I remove it from 53167, it's giving what? 493,417. Therefore. So that is giving 493,417. You now compare 152,500, the lower of the two. Which one is lower from this and this? That's 152,500. So far, that is the lower. You now remove the lower from this, then you now have what? Your chargeable profit. Now, if I get a chargeable profit to 47299, what's the assessable tax? Assessable tax is 85% of what? 47299. That's 402,042. Assuming there is no MOU or PSC or JV or whatever, this 402,042, which is the assessable tax, will be the same thing as chargeable tax. But in the question, I told you, if they say there is an MOU credit, that's based on the arrangement between the oil company and the NNPC. That arrangement will give off what a credit. And that credit is meant to also reduce the tax liability. In this question, you'll be given straightforward. If it is JV arrangement, the credit is what? For the 6 million. That's meant to reduce what? 402 million 4042. To give what? Chargeable tax of what? Of 356,042. This is now what is payable in what? To government as chargeable what? Chargeable tax. You can see. You now say, note, 50% was used to calculating the royalty for deep offshore operations since the debt was not given. So that debt was not given, and the royalty rate are as follows. You know, the normal royalty rate was 5, 10, 15, and 20%. Yeah, 20%. That is the way you compute it. These are the two ways. Though there are three ways. The third way is when you will be notional profit, technical, something as well. You know, all this one that will remove expunged in your pack. It was there in the old pack. I get me now. When there is a penalty between there is a JV and PSC, and there is a penalty. Again, that penalty now, how do they penalize your A company? I get something now. The way to compute that TPP penalty and all that, it was there in the whole pack. But new pack is expunged. So these are the two ways. You can see. They can give you straightforward, one. They can give you just gas, just compute the load factor and so on. Two. They can also give you to work back. So work back, just divide the profit by 0.85. You get the chargeable profit. Add back what they have removed before. Then you now get your profit. And you now get your income. That income now, you now less allowable expenses, less the what? Less the loss and so on, loss buffer, capital allowance, less MOU and so on and so forth, and get your what? Chargeable tax. These are the two ways you can, apart from those theoreticals, which are what I know you will do justice to them, but you don't really have time. Now, any question, please? Any questions? Have any questions? Okay. Now, quickly. That's at least I want to read up on this, please. It's very important. And do that number 2, which I omitted. It's very, very key, very instructive, please. So that's the way to do PPT. Just look at the graph I put there and so on. So let's quickly look at the next topic in the world. Because we don't have time. Let me stop sharing and now see if I can put the next one on board. Thank you. Just give me some minutes, please. Okay. Now, quickly, let's look at another topic just added to your syllabus. That's the digital economy. Now, if you look at it, taxation of a digital economy. Now, when we say digital economy, a digital economy, I hope you are here, please. When we say digital economy, a digital economy is an economy. Any questions? Okay. A digital economy is an economy that is what? That is enabled through information communication technology. That's an economy that is driven by what? By IT. It means that if all business transactions in an organization or in a country is what actually premise on the use of what? On the use of IT and so on. They say that economy is digitalized. You now ask a question, is Nigeria digitalized? Is we a digital economy? If you look at the advanced climb, like US, UK, and so on, you see that all the transactions, they do it online, they receive online, and so on and so forth. I mean, you hardly do physical transactions. Again, you can be in the comfort of your house, and they send goods to you and wire money to them. That's a digitalized environment. Look at it. This is an economy that is enabled through information communication technology. That's ICT. That's an economy that is based on what? On internet. Why I'm doing this, why I'm explaining this, because there is nothing to be explained in the questions. If you don't know this, get me. The question is what I'm actually trying to do now, indirectly, because it's all about this. Get me. Now, for the digital economy, for economy that is digital, it means that they are what? That is driven by ICT. What are the elements of a digital economy? The elements are what? There is an intensive use of ICT. When you can say a country is digitalized, economy is digitalized, there's an intensive use of what? Computer, ICT, information computation technology. Transformation of information into commodities. Information is very key, paramount, prominent, very important. And new ways, there are ways that are doing, there is a paradigm shift in what, in the way they were doing business before and the way it will be done now. I guess what I'm saying now. What are the challenges of this digital economy? So if Nigeria is fully digitalized, in which all our transactions are digital or computer or internet driven, I guess what are the basic challenges that we're likely going to have? Problem of tracking transactions, especially for the purpose of what? Of taxing. Now, where this digital economy affects taxation is that if an economy is digitalized, there is always a problem of taxing that kind of economy. Because things are done on what? On system, on internet. And if you don't have a sophisticated tax system, and those people that are even in the tax area that are driving that tax system, if they're not highly tech as far as what IT is concerned, it means that they will be losing revenue because of this digital economy. So one of the challenges is that there will be problem of tracking transactions, especially for the purpose of what? Of taxing, and also inappropriateness of our tax laws to capture the realities of what? Of modern economy. Our tax law is very archaic and is not able to cope with the realities of the modern economy. Let's look at this. How do we now tackle these challenges? Challenges of the digital economies. What are the best ways of tackling them? How to tackle the challenges of the digital economy? I'll tell you digital economy. One, we have to review the fixed base rule under Section 13 of what? Of Company Income Tax Act. There's what we call the fixed base rule. It simply means that if a company is not having a physical presence or physical presence in your country, you will not be able to subject the company to tax on those transactions it made in the country. It means that under the Section 13 is saying that if a company is not actually having physical presence in our country, even if it's making profits from our country, it will be very hard for us to tax that transaction in our country. That's what the word digital transaction is what that this 13 is saying. It's a law that is a part of the act that is preventing us from maximizing our revenue from from those people that are making money from our country. I guess it means that they have to review it or expunge that 13 in the exam. We tell them in the exam that the way to tackle the challenges of associated with digital economy is to find a way of expunging it, Section 13 from our tax laws, because it's actually debarred from maximizing our tax revenue, and also adoption of creative approach through innovative tax legislation. Like the new finance bill that they brought up was meant to take care of the digital economy and base erosion and profit shifting. Hope you get me now. They are meant to take care of these different ways which companies will find a way of annexing or making money from our country and not want to pay tax on our country. Our law should was upgraded to take cognizance of realities in the new economy, in the new economies. Digital economy. Data handling. Use the power data on digital economy to make decisions. Everything in the country should be driven by economy, by data. If you can use the power data to make decisions, I guess it's very, very apt. I'm telling you, it's very key. I guess what has happened in the past regarding digital economy, let us take that information, that data, let us manipulate it to project and see how we can use it to better increase our returns. Automation of tax administration. We have in our tax offices, some of them are still archaic, can't even operate the system, can't using the software and so on. So it means that we need to automate our tax system so that tax administration, so that we'll all be in line with the realities in the world. Strategic partnership with digital economy service provider. Those platforms that are providing digital service. I guess what I'm saying now, this USST, all these platforms, different platforms that provide all these IT platforms to payment, IT platforms to, let us partner them so that we'll be able to, they will advise us on how we can track all these digital transactions. That transactions that is done in our country but are done from outside the country, I get me now, and they using getting money from our country. I guess what I'm saying now. Because there is no way those transactions will come. If you partner well with the digital provider, service provider, there is no way we will not be able to track. And also capacity development. Let us train our people. If we train them, capacity development will be there and so on. We will be able to meet up with the challenges of digital environment. Look at the institution. This is the only institution they put in your park. So if the examiner is coming from this area, don't ignore if I finish a whole topic. I get something, it's a whole topic, go and check digital economy. These are what they put there, this is somewhere what they put there. Now, the only question they put in your park is what? The one. What are the challenges associated with taxing digital economy in Nigeria? What are the challenges of taxing digital economy in Nigeria? And what measures should be considered to block the revenue leakages associated with many digital economy transactions escaping tax in Nigeria? So the examiner, you can put this as 20 marks or 15 marks, 20 marks. You say, what are the challenges of associated with taxing digital economy? And what are the measures that should be put in place to block these revenue leakages? Now, the challenges. The rapid growth in information communication technology, ICT, in Nigeria has brought with it changes in the way we do business, as most transactions are consummated on mobile devices. Okay, that's a challenge. I guess what I'm saying now, that is making what authority to be able to not be able to maximize their revenue because of most of the transactions we are doing now are consummated on IT platform, mostly on mobile phones. I guess on mobile devices, and that makes it difficult for tax authority to annex to their own. Another one, the inability to adequately capture the quantum of attendant and direct and indirect taxes payable on e-commerce transactions has led leakages in the tax system. E-commerce is when you're using IT, they are still purchasing what they put in the first place. I guess now. Direct and indirect taxes payable on e-commerce transactions. E-commerce is when you are e-commerce, when you are using the IT to do your business. I guess what I'm saying now. There is a lot of leakages in that environment. There are also various profitable business models on digital services that derive income from our countries without creating palpable physical presence. Also, presently, Another challenges is there are some that are outside the country, but are making money from our country. Let's say, for instance, someone is in US, and the person actually sent a software to Nigeria from US, and the software is downloaded online, and the wire money is wired to them, via the credit card and debit card. I guess how will tax authority track that kind of transactions? I guess I'm saying that because the person is not even having presence in Nigeria. I guess I'm saying, but he's making money in Nigeria. I guess I'm saying these are problems, these are challenges that you need to identify as well as affecting the tax authority in Nigeria. And what are the measures to plug these leakages? The measures are the one I told you the other time. Review of the scope of fixed base, that's the section 13. Expunge it. You should review it or expunge it from your tax laws. It's affecting us, it's preventing us from us not making our profit. And that was what the new bill, finance bill, was meant to attract, to attend to. Adoption of creative approach through innovative tax legislations, innovations, automation of tax administration, you added data handling, strategic partnership with digital economic service provider, and capacity development. Those are the measures as contained in your pack. That happens to be 2 topics today. Again, this what we have done is it happens to be a whole topic in the exam. I say thank you so much for your patience. Thank you. If you have any question, you can chat me on the WhatsApp on our WhatsApp platform. I guess on the Zoom and the WhatsApp class. Thank you for listening. I wish you all the best. I pray this exam must be a done deal this time. We are going to qualify and get the certificate by God's grace this next time by God's grace. Thank you for listening. I will have to stop the class now. Thank you, my host. Thank you so much, sir. I appreciate it, sir. Thank you, sir, my host. Yeah.
All right, sir.
Okay.